So cool. So thanks everyone. It's a quick intro. So I'm Glenn Keller. I'm the Chief Product Officer at CRIF in the UK. What we do each year is an annual customer research piece that we call Banking on Banks. This year we decided to focus on ESG, so we thought it would be a good tool to kind of present that to you guys as your banking type people with an interest in ESG. The term ESG, as you know, was first used to talk about how good governance factors could improve market sustainability and lead to better outcomes for societies. But what we're focusing on our report is what about customer sentiment? So aside from being good global citizens and reducing ESG related risks, being compliant with ever increasing regulatory requirements, is there another driver for ESG adoption? And that is of meeting the growing ethical and environmental considerations or expectations from front end or end customers. So each year at CRIF, we run a survey. It's around 7,000 participants across a bunch of countries, and we produce the Banking on Banks report. So this ESG focused one, for the next 10 or 12 minutes, I'll walk you through some of the main insights. But first, I just want to do a quick intro to CRIF because we're not necessarily a brand that everyone knows, but we have been around a while and kind of in the background doing some quite cool stuff. So we've been around 32 years now, a bit longer even, and we're one of the global credit bureaus, but we're not a credit bureau in the UK. But we do another other bunch of cool stuff from running the motor claims database for the Treasury, doing origination platforms for some of the largest banks in here, as well as having a really strong product in open banking and open finance, including credit scoring, ID verification, affordability assessments, and stuff like that. But also in the last few years, we've got a strong focus on ESG. And so just a little bit about our ESG products, but it's not going to be too salesy. We'll just tell you what we do. We have two products, one called ESG Analytics and one called Synesgy. Pardon the pun. I wasn't the naming person, but we did manage to squeeze the word ESG into that, which I've grown to like over time. So basically, we work in with a bunch of kind of global standards people, including the World Bank, to define a global ESG framework, as well as the ECB, the European Commission, and we're one of the only licensed tools providers for the GRI as well, which is a global reporting initiative. So each of the tools, the ESG Analytics is a large data lake, which has insights on every company and property in the UK and the EU. And that covers 140 different KPIs, which includes the E, S, and G. So it's not just environmental factors. So it has a wide combination of public and private data. And that includes things like high resolution climate risk metrics, transition risk indicators, macroeconomic models, scope one, two, and three emissions, water usage, waste production, biodiversity, but also social and governance KPIs, including like modern slavery, health and safety, and inclusiveness. Where Synergy, on the other hand, is a complementary solution. So it's a standalone platform and it's for self-assessment of companies and their supply chains. So it's particularly works nicely at the smaller end where there's not a lot of coverage in data lakes for SMEs as well. It does go all the way up to enterprise. It's already localized in 27 countries, but it can be effective everywhere. And it enables companies to collect and manage ESG data at granular level. It's a relatively short questionnaire compared to some of the ones on the market. So a SME can self-serve and it maps against national sustainability standards like SDG, ESRS, and GRI. And it's actually licensed by GRI as well, certified by the rating agency. So typical use cases for the analytics one is Pillar 3 reporting, stress testing, operational risk assessment, and Synergy has two use cases. One is for companies to provide their own score and get an action plan and a certificate of completion with the rating agency. And the other one is to monitor a global supply chain. So you can send the request for completion to all your supply chain, and then you can get an aggregated view of your supply chain as well as any specific risks and indicators on that. And the combination of the two actually provides an end-to-end holistic solution. So you've got the speed from the data lake and the accuracy where appropriate. So kind of enough about that. Let's get into the report. So it's industries across the globe, particularly financial services, they're experiencing, quoting from the report here, a profound shift driven by regulation and evolving customer expectations around ethical and environmental responsibilities. So the report looks at the widening gap in consumer expectations compared to what industries deliver and focuses on the opportunity this creates for good players to differentiate in a meaningful way. So, let's have a look at some stats from here. So, customers now expect banks and insurance companies to not only reflect their values, but also support their efforts to lead more sustainable lives. So, in our research, we saw a significant gap existing between consumer expectations and financial institutions' offerings, particularly in terms of sustainability and transparency. For example, in the UK, 63% of consumers have taken steps to reduce their carbon footprint in their personal lives, and that was actually the lowest figure from all the countries in the survey, with France at 87% as the highest. And the survey covered the US, Austria, sorry, Germany, Italy as well. Um, to give you an idea, the type of actions, some of them are quite obvious, like taking shorter showers, maybe reducing meat or dairy consumption, recycling and stuff like that. This is also backed up by a separate piece by McKinsey and also Nelson IQ in the US, which found that 78% of consumers in the US regard living a sustainable lifestyle as important to them. But on the other side, only 8% have made responsible investments, 13% in the US, 11% in France, and only 7% use an app to calculate their carbon footprint. So the discrepancy between, let's say, people being interested in this and it impacting their lives and actually kind of it affecting their relationship with the financial institution is quite large. So this highlights the challenge for providers and their customers. While many customers are making environmentally conscious choices in their everyday lives, they maybe lack the awareness or resources to apply the same ESG related principles to financial management. And financial providers can or should take proactive steps to bridge this gap to remain relevant. So, what should we be doing as financial institutions? For example, offering greener, more personalized services and products that align with their customers' values can and that can help their customers reduce the impact of their financial activity on the planet. There's an increasing expectation that businesses, including financial institutions, also should play a major role in mitigating environmental damage while upholding high ethical standards in how they operate. Some research conducted by PwC found that 83% of consumers believe companies, rather than just adhering to ESG principles, should actively engage in shaping best practice in these areas. And similarly, a UK study by Deloitte found that businesses' commitment to sustainability had a significant influence on consumer trust. So, in line with their findings, CRIF's research showed that 6 in 10, 59% of consumers would be more likely to use a financial provider that acts as a force for good in society. This was stronger in Italy, 70%, France, 65%, US, 63%. So the UK was still high, up there somewhere. Furthermore, when choosing a new financial provider, more than a quarter of consumers considered whether the company is reasonable and ethical. But in the US, that was actually 43% versus 28 in the UK. So just to recap on that slide, actively engaging in best practices, action is a force for good, and having transparency in operations. Transparency was a key factor. People listed as they're more like their providers to be transparent about its operations. So let's dig into data a little bit more. So research showed there's a clear generational divide as well. So it's the younger participants that are driving some of these big figures here. As we might have guessed, but it's good to have it backed up by numbers. So leading the call for ethical and environmental minded financial services. So we just pulled out 3 points to mention here. For example, 55% of consumers aged 18 to 34 said they're more inclined to choose a financial provider that actively protects the environment. Actually, it was 44% for those 55 and over as well. So actually relatively high for both for that one. The middle one here is, in addition to seeking greener products, consumers want support on how to better align their financial lives with their personal values. So nearly half of consumers want advice on changing their spending habits to lower their impact. But this is actually 63% in 18 to 34-year-olds. And also interestingly, for CRIF, because we're a data-centric company, almost 60% of 18 to 24-year-olds are willing to share their data to help protect the environment, versus only 18% over 55. So that was the biggest spread on the two age groups. And it's good for things like open banking and open finance and open data to show that the younger crowd are willing to share data if there's a benefit, and not even just for them. So financial institutions will need to tailor their offerings to meet this growing demand as the younger cohort become the main cohort and evolve over time. So, so despite greater sustainability awareness, only 12%, sort of chucking all these figures at you, only 12% of consumers say they've noticed financial service providers talking about environmental activities and ESG related activity. So I think there's a definite opportunity here or a risk of inaction. This suggests that while some providers may adopt sustainable practices, they're not necessarily communicating this very well to their customers or not effectively. So there's an opportunity for banks and insurance companies to set themselves apart by better articulating their ESG activities. If not, the younger generation that are more open to this will act and maybe move to a different provider that does more visibly align with their values. So the two kind of quite big figures on the screen here. So overall, 13% and 19% in the 18 to 34-year-olds said they would switch provider if the current one did not have good environmental practices. So that's a pretty big figure actually. And more striking is 1 in 10 have already switched because their previous provider didn't share their values. So poor environmental credentials can harm reputation and impact customer retention, as an increasing number of younger consumers show willingness to vote with their feet. So there's also a significant potential for client acquisition, because where are these people going who are seeking out providers that do prioritize ESG compliance? So providers that want to retain and reach new customers, ensuring the practices are aligned with consumer values can be crucial. So it's good ESG at the same time is excellent practice from a customer perspective and a genuine opportunity to address customers' concerns and to differentiate in the market. So just really the last couple of slides. In conclusion, the takeaways. So we've heard today there is definitely a substantial growing interest from consumers living in a more sustainable way, especially for younger generations who likely will live with the consequences of climate change. This attitude is reflected in numerous aspects in their lives, but includes financial decisions. Yet, despite the rise in demand, the sector has not fully met the expectations for ethical and sustainable products. So, banks and insurance companies have a significant opportunity to bridge this gap and offer more environmental financial products. They could develop eco-friendly insurance cover, climate-conscious or green investment products, support initiatives that allow customers to make choices to reduce their impact, and contribute to protecting the environment. So more than just carbon scoring, although that is like an easy way to dip into this, but I think it can go to a product level and get much deeper than that as well. So it's not simply enough to offer these products, but financial providers should also think about new ways to promote their services and communicate them more effectively. For example, green financial products could be made more appealing if they come with incentives like lower interest rates or discounts for reward for eco-friendly behaviours. And financial providers can play a key role in helping consumers understand the impact of financial decisions and evaluating their risk more effectively. And lastly, increasing transparency about companies' operations and ESG commitment is essential for building trust. So customers are more likely than ever to choose a provider that's open about how it operates and the values and aims it adheres to. So by acting in these areas, financial institutions can better shift the better meet the shifting expectations of consumers and the growing demand for ethical products. Also, while boosting trust and fostering stronger relationships with new and current customers alike. So, lots to be optimistic about, and a few takeaways to see how to, let's say, be part of the solution. So, just finally, end with a thought. In an era where doing good and doing business are intrinsically linked, financial providers have the opportunity to create tools and pathways that enable consumers and businesses alike to achieve their sustainability goals and feel good about doing it. Have a check out the Banking and Banks report. We can share the link to read the whole thing. And I'm happy to answer any questions you may have. And we've also got some ESG experts that we can all pull in who are more at the data level, that can jump in and answer some detailed questions as well on a follow up. So thank you very much for your time. That's short and sweet. I hope it was interesting.